The first I would like to introduce is Dick van Loonwell. He's the head of EMEA and Latin America at Neuberger Berman, the firm who was, one of the first financial companies back in the 80s to launch the fund of funds, and today has over 100 of billion of assets under management in private equity. Welcome, Dick. Thanks a lot for joining from London. Great to have you with us. Let's start with a very brief introduction to the audience of the capabilities of your private markets platform. What type of private activity are you involved with, and which investor needs are you addressing?
Well, first of all, I'd like to thank you for organizing this. It's really nice to be asked, so thank you for that. It's also fun to be back in the Nyenrode setup, because I remember going there with my dad in the early 80s. I'm a very old person, and I ended up studying in Groningen, but I remember how beautiful that castle is, and it's a bit of a pity that we can't be there live now. But anyway, on a serious note, so Neuberger Berman, a very quick sort of intro. It's a private firm, 100% employee owned. At least in the Netherlands, folks can pronounce it. In Asia, we go with NB, but we're clearly not a household name. Overall, we run about 400 billion, and of which about 100 billion is indeed in private equity. So thank you. That is a combination of fund of funds, which is roughly about 1/3, to your point, on the early roots of the private equity franchise, and the rest is and of that of which part is primary, part of it secondary, and then we have 2/3 of our 100 billion is in more sort of specialist strategies. Could be direct and co-invest, could be private debt, and special strategies such as drug royalty, brand royalty, or taking stakes in hedge funds and GPs of private equity. Overall, we sit on about 230 advisory boards, invest in 500+ funds, so it's quite a helpful network. Some 250 people overall involved across the business out of 2,200, and we allocate about 10 billion in private equity a year. So I think that makes us pretty relevant. Not that size matters, but it's relevant. Europe is important to us. We have offices in most countries, including the Netherlands. We have a big office in The Hague. In Europe, we manage about 60 billion, of which 1/3 roughly is in private equity, and Holland about 9 billion, of which about 1/4 is in private equity. So, and lastly, it's largely an institutional business.
Well, it sounds like you work a lot with institutional investors across the world. So let me ask you this question. What is the current mindset that you observe among institutional investors? Are they bracing for increased volatility, downgrades, and defaults? Or is it for them the once-in-a-lifetime opportunity to go shopping for distressed and undervalued companies?
Well, the institutional clients we deal with are not very tactical or opportunistic. They tend to work ALM driven, almost like super tankers. So what we've seen, and I agree with Ludo, there's a huge amount of demand for private equity services. I don't agree with Ludo on many other reasons, but let's not go there. It's the point is that the typical private equity firm is benefiting from all the institutions who are increasing their allocation, and in many cases just starting. So where, for instance, private equity 15-20 years ago was perhaps a hobby horse of a CIO or a CEO or a pension fund, now it's a strategic allocation between 5 and 25%. And this is not just a developed markets large institution thing, it's also across Asia and Latin America. To give you an example, we're currently working with some of the Mexican Afores on their allocations, which is quite exciting. What's also worthwhile mentioning is that these are incredibly sophisticated institutions, and the conversations are sort of as such. So it's they typically revolve around knowledge transfer. They revolve around educating their staff also on the legal and the compliance side and on the back office side. So investing in private equity is a completely different ball game from investing in public funds. And the other thing related there, because when you partner with a private equity firm, it is good or bad for the long term, because these are 7 to 10 year commitments. So you better make sure that everything works well and that the cultural fit is there as well. So, so in short, to answer your question more directly, we don't see a lot of let's sort of dial up, let's say, distressed debt, or let's dial down allocations because we feel valuations are high, because most of our clients, they appreciate that private equity investing is a program. It's best to do it over many years, to commit over, to spread a commitment, because each commitment again will be spread over many years by the underlying funds. So it is not something where you can be tactical, but because even if you had a view on, let's say, I want to be overweight in Asia distressed, then you have to have that view for the next 7 to 10 years. It's not something that you can exit. Although having said that, and then I'll shut up. Having said that, we do see an increased number of clients who are using secondaries as an opportunity to fine-tune and make tactical shifts, but that's still very small.
Okay, and I'm sure that all these investors you deal with, they are coping differently with the crisis. But one thing they all should be working on are their value creation plans. Are you seeing investors asking themselves, given what happened with this pandemic, are things that I underwrote when I did this deal still true? Are the fundamental underpinnings of what this business needs to create value still relevant? Are the investors asking these questions to themselves? What can you say about the defensive and offensive actions of investors you work with?
Well, look, I think the COVID crisis was a big tragedy, and we all in the financial industry, we've been incredibly lucky and fortunate that we're able to cope and work remotely. So clearly, one of the first things we started doing internally and we started doing with our LPs is over communicate. So I think the best thing you can do is make sure that you're completely, as say, open kimono with your clients on what's working, what's not working, because that gives a level of confidence. It goes back to the partnership that you should have with your as an LP with your private equity partner. So that helped a ton. I would also say, and that's and funny enough, I was reading some research from one of our competitors. They had the same experience, that overall the impact of COVID has been relatively limited on our portfolios, and that's not just a marking delay element. That is just frankly a function of underlying companies coping, and in some cases being supported by the government, in some cases debt being available, in some cases it's just a matter of not being exposed to the hospitality or the travel industry. So let's bear in mind that the casualties were, or the casualties of this crisis were pretty, I'm not saying obvious, but there's lots of industries who did okay and coped whilst not ideal. So I think overall it's been it hasn't been so much a trigger of, oh my goodness, unlike 08, where there was God, this should never happen again. What on earth was happening here? This was a very much an external factor which has massive ramifications, but not I should be managing my portfolio differently. Apart from the more pragmatic things like how do I do diligence on managers, how do I do reviews of companies remotely? That's kind of a more banal point.
Excellent. Well, let's now hear from our institutional investors. We invited to have the discussion today. Let's start with Greg Genia. He's global co-head of private equity at APG Asset Management. Greg, thanks a lot for joining from New York at such an early hour. It's a pleasure to have you with us. For the benefit of those who are not familiar with APG's private equity investments, could you give a brief overview of your activity within the industry and how your portfolio looks like?
Sure. Thanks, Catherine. Happy to join. Thanks for having me. Our program is around 35 billion euros of NAV and about 15 billion of unfunded. We invest across the globe and across sectors, including funds, co-investments, and secondaries. And we have around 42 people in our team across 3 offices, globally. We invest around 8 to 10 billion euros per year to achieve our targeted AUM, which is 6% of our clients' AUM So APG is one of the larger investors, single investors in the world, versus maybe some of our fund-to-fund colleagues. But we're one pot of capital, which has been a great benefit for us over time. It was interesting to hear Professor speak earlier, because I think I need to develop a new test to test for cowboys in the industry. I don't have a cowboy test yet in my underwriting, but I think it's a good point. I'll have to figure out how we can test for that and underwrite cowboys as we move forward in our program.
Excellent. Greg, what is your take on what happened with private markets since the pandemic began? What have you witnessed? What were your biggest lessons learned and eye-openers so far?
Well, it's interesting. There was a lot of concern early on in people's portfolios because the markets turned down so quickly, and it led to a cessation of activity. If there was, very few, co-investments and secondaries being done right after the pandemic hit, because people didn't know where things were going. But it was one of the most rapid turnarounds as well. So between March and May, co-investment and secondary activity almost halted, except for some rescue capital transactions that we looked at. But the regular co-investments and secondary activity really dropped off the face of the earth. But it rebounded very quickly as the markets came back, given the stimulus, from the governments, across the globe. What we learned in those first few months, though, on the fund investing perspective, was that a lot of other LPs, unfortunately, were worried about, had problems in their internal portfolios, whether it's their public portfolio or alternatives. Some people really pulled back from investing, and the last thing they wanted to do was to go to committee to put more money, more dry powder in the market. At that time, they were more worried about having capital available and cash available to rescue other more liquid investments in their portfolio. So we fortunately had a longer term view, and I guess probably had a little better cash positioning as an organization. And so we took advantage of that and actually, put more money in certain funds that we would like to have more capital to, and use the pandemic as an opportunity to get more exposure to a handful of managers that were in the market between April, and May and early June. But unfortunately, that too turned around. So by June, July, August, most LPs were back fully committing to the asset class, and hard caps were being tested and even looking to be increased. And so we saw this feeding frenzy for allocation of private equity that Professor mentioned came back quite a bit in the third quarter, definitely in the fourth quarter. We've seen basically return to normalcy and the upper hand going back to the general partners, on negotiations, fund sizes, etc.
Yeah, it's been a very exciting year for you, I guess. Let's just talk in a bit more detail about your investment and asset management activities. So on investment management front, what can you say about the market dynamics starting from the beginning of the lockdown? Did you push the pause button on all your activities, or have you had your best year ever in terms of deal making?
Yeah, it was our most robust year in terms of number of deals and capital deployed. Because there was a shortage of capital early in the year, so we were able to take advantage of that during the downturn to get a few more deals done than average. But coming out of the crisis on the co-investment secondary side, there were people who decided to lighten up on their activities in secondaries. We took advantage there. There was a few investors that were looking to kind of move more assets in the public markets instead of private assets. We took advantage of that in the secondary market. And then when it came to co-investing, there was a rebound in transactions, and there's more GPs these days that want to go it alone. They don't want to partner with other GPs. So we saw some large transactions emerge in the back half of the year that allowed us to put much more money to work in co-investments. So for our team, it ended up being our biggest co-investment year on record, and our biggest secondary year on record. And the fund's activity stayed relatively normal. We were at target, but we exceeded our target on the co-investment and secondary side in terms of number of deals and total dollar or euro amount of deals.
And on the asset management side, is this pandemic changing how investors such as yourself and the GPs are managing their portfolio companies? And also, going back to Ludo's comments about, potentially emerging winners and losers, what is your experience so far?
Well, as I think was mentioned earlier, there's been a big exit of asset classes like offline retail and energy, and a big increase in assets going into healthcare and technology. And and our portfolio is relatively young, so we only started investing on an in-house, from APG's own balance sheet in 2012 and 13. So our portfolio already had the characteristics of being, probably, overexposure to healthcare and technology in general, because we didn't have a legacy portfolio that might have had more retail or energy in it. Also, given our APG's, ESG concerns, we were underweight energy compared to most other asset class, most other investors. So at the start of the crisis, we had less than 10% of our portfolio, I think less than 8%, in energy or retail. And so those industries were the hardest hit throughout the first 3 months in the last year, but we had a relatively small part of our portfolio there and affected there, and we're more exposed to healthcare and technology, and again had a bigger increase in those portfolios in the back half of the year as well. On the portfolio management side, we were pleased to see that the general partners generally took a very active approach in being transparent with the LPs. So we saw very much an increased communication cycle, using Zoom and other technologies, webinar teams, to have more and more frequent dialogues on the status of their portfolio. So we never felt like we were behind the curve on knowing what was going on. We would get pretty frequent updates from our 90 GPs in our portfolio, and even in some cases having weekly updates with members of the deal teams at the GPs to hear how things were tracking, where leverage was, covenant violations, if any, traffic, all that. So we thought it was actually good to see the GP step up and increase the communication and transparency during the pandemic. Because that was so much additional work, we're seeing a pullback in that frequency of meetings, because you really can't handle that many meetings when things start going better again to some extent. We've got our normal work to do, new investments, but I did think it was a good thing to see the GP step up, provide the extra communication and dialogue with the investor base to make sure we felt connected and included in knowing what was going on.
Thanks, Greg, for now. I now would like to introduce our second institutional investor on the call, Mark Royaker. He's the head of the Global Alternative Investing at Blue Sky Group, and is also a board member at Invest Europe, an organization that represents interest of private equity and venture capital investors in Europe. Thanks a lot for joining, Mark. Let's also start with a very brief introduction of Blue Sky Group's alternative investments platform, and more specifically, what kind of private equity programs do you execute for your clients, Dutch pension funds?
Thank you. Well, it's a bit similar to Greg's story. We initiated the program in 2012, so it's still fairly young, but it's equally diversified. It's a global program focusing on secondaries, primaries, and about 3 years ago we added co-investments to the program as well. And it's about roughly, we manage a bit north of 21 billion euro, and we allocate about 5% towards private equity. So currently we have 1.8 billion in commitments and about 1 billion in NAV.
And what challenges and complexities did your private equity business have to navigate through during the pandemic? What was your experience similar to Greg's?
They were more or less similar. So yeah, they were more or less similar. So we started once again 2012. Ever since private equity had great tailwinds. So our clients reached out and asked, okay, what can we expect will be the impact on private equity? So we reached out to the big fund of funds, a lot of our peers who had been in the S class for many years longer. And as a result, we anticipated that there would be a drop in valuations, about half what we saw on the public market, that we expected a full stop in liquidity, no new investments, no divestments. And we would expect fundraising to stop as well. Well, none of the above happened actually. It happened only 1 quarter, but ever since it has more or less been busy, business as usual. Even though I would dare to say that on the co-investment front, the 3rd and 4th quarter were exceptionally busy. Yeah.
And how resilient were your models throughout the lockdown period? Were you eventually able to steer portfolio companies into safety? Or were your investments, less affected than you have initially anticipated?
Well, first of all, they were much less affected than we anticipated. and it's equal story. As we started in 2012, we have less exposure to energy and offline retail, much more exposure to technology, and that of course is in great shape. And once again, we were positively surprised by how proactively all managers reach out, giving us indeed weekly updates what was going on. But second to that is if you see how liquidity came back to the portfolio, particularly on the technology side, it's on an exit mode. You can argue a little bit that is fiscally driven in the US with a new government in place, and there's talk of a different taxation. But we have seen a strong portfolio. Yeah, absolutely. And fundraising, it's been as busy as ever.
Well, I'm only hearing of the very positive